because basically, in a nutshell, and it's a long read, but it's very good. It's worth reading. That's why I posted it in the chat. Maybe you download it and on your time you could read it. But basically, he does a very good analysis in regards to, in comparison, in regards to all these big companies, Oracle, Microsoft, OpenAI, um, NVIDIA, they're all a lot of the revenue that's they're earning, they're buying off of each other. So they're investing in each other and they're buying off of each other. And what he's saying is this comparison, if you remember, Enron had these special partnership entities where they would a lot of the debt and a lot of the bad stuff would go to these entities. It's very similar with their structures because it all works when things are high. But if things come down, it comes down like a tumbling card. Just so it's just a thesis, but it's very interesting to see, and especially that he's not wrong in the fact that a lot, how much of this is true, like revenue from the outside versus how much is it revenue that, well, NVIDIA buys Oracle and then Oracle buys from NVIDIA and NVIDIA buys from Microsoft and they're just trading back and forth billions in revenues that are just going in circles, and how much of it is real revenues that is sustainable. So it's very interesting. Now, obviously, everybody knows that we're in a bubble, and we just don't know what kind of bubble. Is this a similar bubble to the tech bubble? Is this a different type of bubble? Because now I think we at the last meeting we talked about it that because I had to review the last meeting to put together the minutes, and we talked in the last meeting we talked about how this is a different bubble because at least the tech bubble there was no revenues. Here there's revenues, but then is it different because if those revenues aren't real revenues, they're just rotating those revenues amongst all these top eight big AI companies, then you really have to dissect through that and see, and then when will the house of cards fall? So that's important to take into consideration. Obviously, we don't have a crystal ball. We don't know when it's going to drop, but we would predict that it would crash. And then we also talked in the last meeting about, well, then if don't be greedy. I think Nick Nikiforos said start taking some out. You don't have to take it all out, but if you're up 100% or even 50%, take 10% of your earnings out or slowly start taking out. That way you're large. Even if you lose, if it goes up another 20%, that's okay. It's better than if it goes down 100% and you said, I should have taken some out. But if you took some out, you at least realized some of your gains. So this is just something, food for thought. Again, we can't predict the future. No one knows. This is hard to predict. We don't know where this bubble's going to go. We don't know where AI is going to go, and how long it's going to last. But it's an interesting read. I think that everybody should take the time to read it and do some comparisons to the tech bubble, and then also comparisons to Enron and the moving around, the what's real versus what's not. And that's it for me.
Yeah, there's an excellent learning in the article or podcast in Better Investing by Craig Beamer, Baemer, about trimming stock. And I've heard him talk twice. And his clubs automatically trim when they hit a specific percentage of the portfolio. It's I read something along those lines yesterday, and they're spending about $1 trillion a year on this artificial intelligence build out. And in comparison, in inflation adjusted dollars, the entire United States interstate system was built for $600 billion in 2024 dollars. So they're spending almost twice as much each year as it took the United States government we taxpayers, to build the entire interstate system. I thought that was amazing. So, um, I mean, it's obviously different than 2000 tech bubble because a lot of those companies had no profits, some didn't even have revenue. But when is this all going to stop? Is the big question is, are these big companies like Alphabet, Microsoft going to be able to make money, make real profits off of this? And if at some point they aren't making real profits, the AI investments they make are going to dramatically decrease and buy fewer chips from NVIDIA, et cetera, et cetera. But nobody knows if that's going to happen and when that's going to happen. But I don't have any crystal ball, but it's very interesting to read all sides of the issues. I completely agree with Christian's article. Okay. Secretary Port,
We
want to
have
make any
quorum, Randall.
Oh, great, great. That's perfect. Secretary Report, Christian, any comments on the minutes?
No, just I sent it to everybody in the last night. I don't know if everybody received it. I just want to see if anybody else has any comments or concerns in regards to the minutes. If you had a chance to read them, and if not, then I would submit a vote to accept the minutes, and then I can upload them to the my iClub.
Do we have a second?
This is Valencia, second.
Thank you, Valencia. All those in favor say aye.
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 All opposed? It carries. I will make a comment in last month's Treasury report. VEEV, we've owned for 2 years and it's down to 17%. As ResMed we've had for 1 year was down 25% at that time. I thought that very interesting in the minutes. So now we have our illustrious treasurer, Ione, to discuss our treasurers. So Ione, this is last month's.
Yes.
Charles Schwab. Total amount was 53,005. This morning, it's 59,000. So it's up about 6,000 minus the $600 we get. And so over $5,000 in 1 month. So everybody pat themselves on the back. Any comments, Ione? I'll let you take it away.
Thank you, Randall. I did notice, which is one of the reasons why I didn't send the screenshot the Schwab screenshot to everyone, is because at the time that I was doing it earlier in the week, the market was still open. So thank you for including that. Let me give me a second to pull it up. And I can do a quick share screen.
I'll stop sharing.
Okay. Okay. Hmm. Oh, wait. Sorry.
I can bring them up if you can't, Ione. I
Yeah, I'm
downloaded your
having
reports.
okay.
You want me to do that? Or do you have it?
Yeah, I just ended up getting it, so I can open it now.
Okay, okay, great.
Okay. So let's share screen. Okay. So valuation statement as of a few days ago, we could see, to Randall's point, our portfolio is just shy of $60,000. We currently have $886.11 in cash. And our biggest holding right now is Google, followed by Qualysys, NVIDIA, and Ali and Microsoft. So that's it. I do want to add a recent thing we need to add to the agenda, Randall. One of our members contacted me yesterday, Cindy, and due to some personal circumstances, she would like to exit the club. So I want to make sure that we add that to the agenda so that we can vote on it today, and then plan to process her exit by next month. Any questions on the treasurer's report by those in attendance, partners? Okay, thank you.
Let's see now. Well, let's take care of what you just talking about just now.
Okay.
So Cindy, I really like Cindy. I'm really disappointed
Me
to hear she's
too.
leaving.
I know.
I really,
I
really like
know.
her. But we have been,
I
so
know.
she has currently $2,462
Mm-hmm.
approximately. So
Mm-hmm.
I will entertain a motion to let her withdraw from the club.
I would like to make a motion to accept Cindy's request to withdraw from the club. She's one of our founding members, so the time requirement of 2 years has been met satisfactorily.
Do we have a second, please?
This is Valencia. I second the motion.
Okay. Well, as I said, I'm very sorry to see her leave because she was always timely with reports and everything. I really like her a lot. But anyway, all those in favor say aye.
I
Aye.
Aye.
All opposed? Okay. The other thing I wanted to
Okay.
show here while I'm on this is our club benchmark. Can you all see this?
Yes.
Yes.
So let's just look at let's take a hard look at ourselves. And I have the S&P 500. The total stock market's probably a little more accurate because it reflects small and mid cap stocks too. So for this year, Hub's doing 22%, the others are about 23 to 24%. 1 year we're 16, very similar to S&P 500 total stock market. 3 years, we're fairly similar. But as we've talked about for the first 2 years, we were learning. It's a process the club goes through. And so our first 2 or 3 years in the club, not surprising, weren't that great. So, I think that's to be expected. You can see that all in the graphs. Now, as you know, the Better Investing wants members to do 5% better than the market. But the markets have been so hot in the high tech stocks, I think it's been very hard for many clubs to stay up with the indices last couple of years. So, but that will be our long-term goal, to beat the market at least by a few percentage points. I think we're getting a lot better. Any comments, Ione? Or Chris, or somebody want to comment on that?
Well, my only comment is I've been a member of Better Investing since 2018, and I've been part of many clubs. And since 2018, I've been looking at this and I haven't seen one club that has been able to beat the S&P 500. Now I know the last 10 years S&P 500 has been on a tear. And so, but it begs the difference is like, why spend so much time and effort and energy picking stocks if you can just pick the S&P 500 and you're going to do just as good and avoid the risk? It's almost like it's getting to the point where, geez, if I would have just put my money in all in the S&P 500 since 2018, I would have done a lot. It's just getting to the point where, man, it's getting more difficult to pick stocks because the S&P 500 does so well.
Yeah, that's obviously why in your 401k, we all should have index funds, like the S&P 500. But I don't disagree with you. And it is and we all know it's hard to beat the indices. I do know of several clubs that do beat the indices, but they're more mature clubs. I think there's a secondary there, understanding is if you're in a club, you get to learn to understand the stock market. And so when the market has a period of time it's crashing and all your friends are thinking about selling, your education from Better Investing makes you realize, no, this is likely a short intermediate problem. I'm not selling. If I have any extra money, I might put it in, but I'm not selling. And I think that's also a benefit to them. There's a lot more than, but it is hard to beat the indices. Chris, it all shows that. I completely agree.
I think too, and I'm glad Christian brought this up because I hadn't thought about it until he asked the question. I think us learning how to evaluate high quality growth and value stocks allows us to buoy ourselves during a downturn. So we may not necessarily um, beat the market at this young age or stage during a boom market, but I do think that with the stocks that we pick, because we are actually researching the companies behind the stocks, during a bear market, we actually may not experience as low of a low as the total S&P 500. So those are my 2 cents on that as well.
Okay. The next thing is the Valencia's report. Uh-oh, what did I do that? I should have done that. Oh, what did I do to Zoom? What did I do? I must have gotten out of it. Excuse me as I try to correct my stupid mistakes. All of a sudden, I'm out of the Zoom. How did I do that? I'm still in the chat. For some
You
reason, I
may want
can't.
to, if you see your My iClub, you may want to minimize the window and then it may help you
Well,
to
it's already,
see.
yeah, it's already that's it. That's minimized.
Okay. Well, I could
Just,
take it over and then
oh,
you
here
can
we go.
retake it
I
maybe
got
to
it. I got it.
okay.
I found it. Okay. Thank you. Okay, so stop sharing on that. And we will bring up, okay, share. We'll bring up the PERT report. So
Yeah.
here we go. Here's our reports. And we'll go to PERT and we'll let Valencia take it over.
Well, happy Saturday, everyone. So based upon what we have already discussed, ResMed is one that comes out of the report to be one of our bigger concerns. First, let me go back let me do Netflix.
Okay.
Netflix, last month we were looking at the same concerns. They are for their earnings per share, their sales, they're all down. However, the trailing 12 months, I think that we need to keep our eye out for that one. And although the stock now is at, I show 78 points, yeah, we have the same number, $78. Um, it's still considered a good buy. The projections are still good. I'd like to wait this one out to make sure that we really give it time to grow. As we know, the PERT report identifies specifics that we actually evaluate in terms of a quality stock and the earnings per shares and sales and pre-tax profit as of now are downward. However, again, this is the second month for these three categories to be affected by what's happening with Netflix. And I don't know if it's just the summer months, perhaps it's just the behaviors. If anyone have any feedback of how, what else that we should be looking at when it comes to concerns of Netflix and how they'll move forward, which I think they'll survive. They're doing a lot of different things, specifically in the podcast. And now I heard that they're going to shorts. So I do know that they're changing up how they approach, how they're moving the company forward in this day of streaming. And so, but our other concern is, which I think is ResMed. ResMed, I think we were down 25% last month. And this month, I think it's 11 total, 11% when we're looking at the previous report. And it's in the trailing 12 months. I know we said that it's 4. We're looking for the 4 magenta colors in when it comes to the quality of stock. And the fourth one is the trailing 12 months. And now that we're hitting off 4 categories, now this was the same as last month as well. I don't know how much longer we should hold on to this particular stock or what we should do in terms of trimming it. It's something that we really need to discuss because I believe we've lost on this one in its totality, if I was looking at it correctly before. So we're not only losing, it's lost the quality, what we consider to be the quality characteristics of a quality stock. And that's where I stand with this report. As for Visa, I think we had the same issue with them, but someone did the report on Visa. We're not concerned about Visa, or we're not concerned about Qualys at this time either.
I'll make one comment, like about Netflix. When you said their profits and sales are down, well, the amount of growth is down. But the reason you have magenta lines is we, in our stock selection guide, expected the sales and earnings per share to be, I think, higher than 15%. And they were like 13 and 11. They're not going down. It's just their growth is leveling off. It may go back up. ResMed, though, I mean, their earnings per share were only up 2.3%. And these numbers only change every 3 months, Valencia, because they're by quarter. So they won't change. They'll change only every 3 months when the next quarter comes out. They don't change month to month. But I would agree, RMD looks more worrisome to me. Let's see. Any comments from anybody else looking at this?
And really quickly, when we talk, because it reads from the SSG report, correct? And
Yes.
as long as we keep, I encourage us each to make sure that we're updating at least, especially when it comes to the quarter, our SSG, so that we can go back and maybe reevaluate these stocks to kind of see whether or not our projections may have been off, or are we reaching and be a lot more, I don't know if we should be more conservative. I think we do a good job at how we select in terms of what we project. And I think we are kind of, I don't know how I want to phrase this correctly. As a club, I know that we choose conservatively. And that means when we're projecting about the sales, what we anticipate in sales and the earnings per share. I don't know if we do that independently. I know I'm not as, I think I'm probably far more conservative and I don't go very high. But again, the PERT report goes based off the SSG. So if we were unrealistic in our projections, then it reads back into the PERT report. So I just wanted to make sure that we are being optimistic when we set those parameters in the SSG report, so that when we do that, we have some sort of standard. I hope I'm saying that right.
No, I think I understand.
We understand.
Yeah. Here's the
So I have a
summary for it.
question. I have a question on that. If we can go back to
Sure.
that real quick. So
Sure.
yeah, so my understanding is that these magenta shades are based on the SSG report that was put in originally. So when we decided to buy ResMed, we used an SSG, and we based our decision to buy ResMed off of that SSG. So what I understand is this should be is, hey, we put earnings per share at X% and it's not meeting, so it's magenta. We put sales at X% and it's not meeting our expectations, and it's in magenta, and so on and so forth. But again, if you update that ResMed report, it's not the original one that we based our buy on, but I guess it still shows whether or not we still should consider it or look into it, or I'm a little confused on that. Does anyone have any better understanding on that?
Let me show you something. Let me show you something else.
Wanda,
I
this
think-
department, and I follow ResMed. I
Okay.
see that they just closed the last quarter, so 2026 is closed. I'm expecting next month I'll be doing the report, but just
Okay.
look at the SSG and the
Mhm.
report. Can you bring it up? It was
I want to show something else. Just give me just a second.
okay.
So when we're looking at our portfolio review, can you see that?
No,
The
not yet.
portfolio.
On the screen.
Oh, I'm sorry.
You have to
Okay.
share.
I have to share. I always forget that to do that. It bothers me. So this is iClub. And if one does not update your SSG that's linked to the club within a week before our meeting, we don't have updated data. So Connie Morgan's updated, Randy's updated, Christian has not updated his SSGs here in a month. Valencia's updated. Yvonne is 4 months behind. Ali is 4 months behind. Qualisys is 6 months behind. And so when I bring up, I can't use these numbers because they won't print out, because the members of the club are not basically going on. And I'll show you what you have to do so everybody knows. So let me stop sharing that. Let me show you. All you have to do to update is really very simple. You go onto your Better Investing website, and all you have to do is click this button, says All Studies, and update all your studies. And that will automatically update your stock, SSG, and will automatically update it into iClub. But since or a lot of people aren't doing that, I'm using SSGs that I got from the club, and I updated them myself. That's the only way I can do it. Just want to make that point. Now, ResMed, I'm sorry to kind of, Harmony, what are your thoughts? I'm sorry to interrupt you.
Yeah, if you pull up the PER report and keep in mind the 9 and 11.
Okay. Okay. I brought up the, I'll go back.
Just to follow Christian's, because that's a good question. So if you look at ResMed, you can see on the right side under estimate earnings per share growth, it says 11%. That's what the SSG said that we saw just a couple of seconds ago. So that my 11 cents, I should compare it with the TTM earnings per share, which is 9.7%. So it's lower. That's why it's magenta now. However, this is a medium-sized company, and for a medium-sized company, maybe we always, in general, BI says that the medium-sized company should grow between 7 and 12%. So it's within the range. So now we have to decide it if 11% is too high, and we might have to review the SSG and decide maybe a 10%, a 9%, a 9.7% should be fine or not. Then we should look at sales. We said that it was 9%, so it's 8.6. That's why it's magenta. So you might say, well, 8.6 to 9 is very close, and it's within the range, 7 to 12%. So those magenta colors bring the stock to my attention. And if you go to the SSG and see the peer report, sorry, Randall, but you are pretty good at this.
I'm going, yeah, okay.
So you compare with peers, the tab with the on top of forecast, you have compare peers. Yes. So you can start with earnings per share. We can see that the black line is ResMed. No, just put the peers. Or if not, it's too many lines.
Okay, I'll take away
Okay.
some.
So you can see that the trend line is going up in terms of sales, and compared with the peers, is I mean, we saw who are the peers they are. I don't know which companies are those.
Outperforming.
So but I like the trend line is going up. Then if you move to earnings per share tab, the historical earnings per share tab, you can see that the ResMed is doing better than peers and the industry. And if you put the historical pre-tax profit, it will show you okay, well, there is the margins. Okay, there is the pre-tax profit historicals. The trend is also going up, and it's better than the peers and the industry. Or the industry, I will say that my trend line is more consistent than the industry. And if I go to profit margins, which also are very important, it's going up. I know when I did one of the analysis, because that was a concern, why we're not making money in ResMed when I'm looking at the fundamentals and they're solid. We bought it too high. It was above the average high PE, way above. So we need to wait. The price will come down and then we'll start coming up again, but we bought it too high. So that's why it's important to pay attention what PE we're using when we buy the stock. And of course, it will tell you the SSG is in the buy zone. But I think that was my conclusion at the time. And I think that was back in, Randall, you might want to refresh my memory, probably March, April, something like that. I remember that was my conclusion, why we're losing money. It was before Bink, because at Bink, they talk about that too. We bought it too high. That was it.
Well, I would certainly agree that one of the most common mistakes individuals and clubs make is looking at a stock, getting excited about it, and paying too much. I certainly agree with that. You see that the last page of the Better Investing magazine, they compared what they did 5 years ago. And when they make their own mistakes, they said, well, we just paid too much for it. It was purchased at a PE that was higher than its average, even though it's done reasonably well, or the P's may have dropped, but we paid too much. I don't disagree with you at all. So. Just look at the quarterly data.
Thank you, Carmen, for that. I appreciate that.
Yeah, last quarter, the earnings per share were disappointing at 2.3%. And the other quarter is like 10 to 15%. But the year before, probably when you purchased it, the earnings per share were going up 40, 60, 21, and 30. That's probably when we purchased it, somewhere around there.
And that's probably why we were willing to purchase it at a higher PE.
I would agree. A good point. And just the growth of the earnings per share has dropped from these very high 40, 60, 2130 numbers down to
In half.
low teens, and then this past quarter,
Mhm.
2.3.
Right.
So
Mhm.
anyway, that explains a lot. And that's part of the education we get as a club.
Well, I thank you because exactly what I was alluding to. Thank you, Carmen, for bringing context to it because I didn't know whether or not where were we when we decided to make that purchase, and just want to make sure. Well, I don't think. Thank you. I just appreciate it because.
No, thank you for bringing it up. I mean, this is an Excel exercise. That's when we learn. Because it's like, well, what happened? And it could have been, well, when I did my analysis, because sales grow up 8%, 8.6%. So why it's so much a difference? And pre-tax profits at 3.5. So maybe taxes increases between pre-tax and earnings per share because it's 3.5 down to 2.3. So that probably will have to pay attention on my report for next month. And also sales 10%, 9.7 medium-sized company shouldn't be bad, but compared with the 16, 19, 29, 40%, of course it looks awful. What's going on with this company? And maybe there was an acquisition back in 24, and that's why everything increased. I have to look, because if you see sales are 9.9, 9.4, 9. So it has been very consistent in terms of sales growth. It was just the earnings per share. It could have been easily, I mean, reducing expenses of some way. I will look at that. So I will report on next month.
Well,
Great.
I can in
Sure.
the comments, Miss Iola Mason, who's a guest, and she's a Better Investing member, she just commented that she just bought ResMed because it purchased Noctrix, which is a leg band that helps improve restless leg syndrome, which is the third most prevalent sleep disorder globally, and Medicare now pays for this equipment, which is potential patent base is massive 17 million, affects 17 million Americans, and the device costs approximately $7,000. I know that I have sleep apnea and I can get all the ResMed equipment, and boy, they're calling me all the time and selling me, and that equipment's expensive. And of course, if insurance pays for it, then you don't really mind. But so that's something to consider. Yeah, I guess you're right. Since 24, it was really good. The last quarter is good. I guess we'd have to keep an eye on it and see how this all affects. Is revenues going to continue going up or down or vice versa? It's one of those, I guess it's a lesson that the Magenta is to let's keep an eye on it and see what's going to happen.
Yeah,
Yeah.
that's what the Magenta says. It's just, okay, this is not what you thought. Keep it off of it. And as we said before, you have to wait a couple quarters, almost any company has every once in a while a bad quarter or two, and then it turns back around. So at least that's been what I've learned from Better Investing. Debbie Hawks raised her hand.
I did. I just happened to look into ResMed, I think last week, and I'm sure when you guys review it next month, you'll see, but they just recently had a big recall on a ventilator, and they are experiencing some issues. I'm looking for where. Let's see. Let me see. They suspended sales of the Astral 100 and 150 ventilators after a component was found leaking, damaged the main circuit boards. And so it's a class 1 recall. Replacement of the circuit boards are in short supply. So anyway, this is something that literally just came out. But they're also, management can't fully absorb the cost inflation, it says. So they have only here, let me see. Trying to synopsize this big thing that I had done the other day. So it says here too, the 2027 guidance disappointed investors. The combination of these issues showed up directly in the outlook. So anyway, I would take a look at it. I mean, I didn't sell it because I feel like it's a company that isn't just like a one product company. They have other, they're invested in many things that isn't, but this one particular, they do have some challenges coming up. So just
Okay.
something I would suggest taking a look at.
Okay, thank you very much.
Mhm.
Let's go on. The next thing on our agenda is to discuss the officer elections for next month. The current nominees are Valencia for president, Laverne for secretary, Ione for treasurer, but we're still missing a vice presidential nominee. So since the election's next month, does anybody have any ideas or suggestions or raising your hand?
I'll be willing to take the vice presidency.
Well, thank you very much. You just made my morning.
Excellent.
Okay. Very good. So we have stocks to review and everyone's in the portfolio. The first one is Google with Connie. Is she on?
Yes, I'm here.
Great. Go ahead and share and we will watch.
Host disabled participant screen sharing. Hello?
I'm not screen sharing now.
It's okay, I'll try again.
Yeah, you have to hit share and then select in your box which one you want to use, Connie.
It's not coming
No,
up. It's telling me host disabled participant screen sharing.
Uh-oh, I'm not the host.
Who's the
Anything
host?
about that? Either Ione or Ann or
Let me see if I can. I'm looking now, but
that's gonna be
let me
everybody
s-
else, I imagine. Yeah.
I hope not. But you emailed the item, right, Connie? I saw the email. So do you want me to
Yes,
just pull it up? Because I'm not
yes,
sure. Which one do you want me to pull up first? The quarterly report?
yes.
Okay, give me a second. Can you see it?
Yes.
Yes.
Go ahead, Connie.
Okay. Oh, why does it look like that? Okay.
Oh, you know what? Let me see if I can take the.
It's okay, I can read it from my screen.
Okay.
Okay, I'm ready. Okay, the club currently owns 29 shares of Google at an average cost of $157.18. The closing price on August 14th was $343.90 per share. The most recent Value Line report is dated July 31st, 2026. The most recent quarter is June 30th. Last quarter's sales growth is 24.2%. Last quarter EPS growth is 9.11. Value Line forecast sales growth is 21.50. Value Line forecast EPS growth 3%. SSG forecast sales 12.3. SSG forecast EPS 13.3. At the current price of $343.90, the stock has a present PE of 49.8%, which is above the average PE of 21.7% for the past 5 years. The relative value is at 80%. The upside down ratio is 1.4 to 1. On the SSG, the stock is currently at a hold, which is in the buy range of $182.70 at a 25% forecast low price. That's it.
I
So
have
Cindy,
one
I'm
quick-
just looking at my phone and Google has a current PE of 17 on
Current PE at 70?
17,
Oh,
17.
17. Okay.
And
Yeah,
you
and-
have present PE of 49. Those numbers are obviously dramatically different.
Well, and that's the other thing I was going to say. The relative value 80, if it's a present PE of 49 and an average,
Yeah.
is
That
that
doesn't
80?
fit. That doesn't fit.
Okay, well, on the SSG, when I look, that's when you go, let me see, what page was that on? It says the relative value is 80%.
That makes it cheaper, lower PE than the average PE is what relative value measures.
Mhm.
And you said only 3% earnings per share growth. Let me just look at that quickly on my thing. Come on.
So when I go to the ratios on the bottom,
Yeah.
where it says valuation ratios, that's where I
Yeah.
got that 80% from.
See, Morningstar says earnings per share long-term estimate 17.9, not 3. So that number doesn't make any sense to me. And the current PE is 17.4 on the stock selection guide right now. This is your stock selection guide from a year ago that's I've updated. I've always did is hit the update. So your own stock selection guide says the current PE is 17 versus an average of 21. So I think somehow those numbers are wrong in that slide you presented. I'm sorry, I don't mean to be rude, but
No, it's okay. So on the valuation ratios, right? On the SSG, when I click on ratios and I scroll all the way down to the bottom where it says valuation ratios,
okay.
and it says current valuation, it has 80%. So that's not correct?
The relative value,
Right.
yeah. It's your 17.4 current P, not 49, 17.4 divided by the average P of 21 gives you a relative value of 79. It's not PE, it's the relative value. So
Oh, okay.
if your current PE is the same as your average PE, it's 100. Okay. And if it's cheaper, if the current PE is less than the 5-year average, it's less than 100. This one's 80%.
You want to
If
share your
it's
screen, Randall, for
Sure.
the SSG?
I
Yeah.
would be glad to.
I think in short, Connie, you are correct. The relative value number is correct. It's the PE number that's
Yeah.
incorrect.
Yeah.
Okay.
So this is
Maybe
y'all
it's
seen my
the
thing.
transposing of the numbers.
And Connie, this is your SSG. This is not. I didn't create this one originally. You did
Okay.
last year. So relative value is 79%. Projected relative value is 68%. Your PEG ratio, which is your projected PE, 15, by your earnings per share growth, 13 is 1.1. Less than 2 is good. So I don't know where that came. I think you may have transposed a number, but this is an excellent SSG that you created, and I'm using right now. See, it says South Florida Model Club, Connie Morgan, right there. So this is
Yeah.
your SSG from May of
Okay.
24.
Three pictures.
Yeah.
Connie, I have your other thing up. Let me share it and then
Okay, I'll stop sharing. Yeah.
redirect you. And you did a great job highlighting on the value line that you sent out to the club. So for the, let me see. Actually, Let me see if I could do a side by side.
Yeah, we're seeing your value line now, Ione.
Okay, but I'm going to share my entire screen so that I could we can see the value line and the Word document. So again, this is a progress for Connie in the quarterly report. So here, Connie, for the value line forecast sales growth, you inputted the actual numbers and not the percent. So on your value line, you did a great job selecting the numbers, but actually these two numbers come from this box here.
Okay, the annual rate. Okay.
Yeah, annual rate. So for future reference, when we're filling out number 6 on the quarterly update form, the value line forecast sales growth should be 15.5%, and then the value line forecast earnings per share growth should be the earnings, which is the 17.5%.
Okay.
Yeah.
Thank you. All
And
right.
then you're welcome. And then in your section 8 of the update form, I need to see if I can, let me see if I have this open. Nope. Wrong one. Too many things up here. Okay, there we go. Move this out the way.
What I have
Okay.
noticed on the SSG that Connie sent, it was
Uh-huh.
not updated. So when you calculated your
Right.
price, it was 2025 number rather than the TTM earnings per share. So that makes your low price not to be the right one, and probably the upside down ratio might have an issue there.
Right.
You
Thank
saw
you,
that too.
Carmen.
Okay, good.
Yeah. So the last point, Connie, is so in this section 8 of the quarterly update form, at the current price of 34.636, or you updated the more recent one, this stock has a present PE of, and you would get that PE, the 17.4 here that you have highlighted, right? So that was Randall's point, but I think that this was a good opportunity to help you visually point where to pull the numbers from. So the present PE of 17.4 on the SSG would come here, which is below the average PE, which you did correctly, the 21.7 in the purple. Yeah. And then that is what would give you the 80%.
Right.
So it was just a transposing of the numbers, but I
Yeah.
think you did a great job.
Okay, thanks.
Thank you. You're welcome, dear.
Yoni, point her
Yes.
out the 10.81 rather than 1991, because that will change her SSG too.
Where? I'm missing
The
something.
calculating the low price, she has as current
Oh,
1081, and it's probably on the SSG is manual, not automatic change. But the TTM earnings per share is 1991, which makes a low price at a PE of 16.9, the way she has it, of 336.5, no 18, no, what's the number she has? She has 182.
182. Okay.
Okay.
But Carmen, where is that? You talking about selecting it on the front
The low
side?
price, when you calculate the low price, it's supposed to be the current TTM earnings per share. So probably the SSG was not refreshed And the data
okay.
she has, or maybe it was just manual updated, not automatic updated when you open your SSG.
It's automatic. If you set
Okay.
it to automatic, it'll do it every well after
Yeah.
that. Yeah.
But it's
Carmen's
on the
right.
SSG.
Yeah. Yeah. She's
And
absolutely right.
And you can see on the table above, column C,
Uh-huh.
2025 was 1081, but TTM is 1991. You see the,
Okay.
yeah, so that makes a big difference on your low price.
Yeah.
Okay. Okay. Thank you.
Okay. So the next stock is Microsoft. Mariama's not here, but I'll go ahead and share that stock. So let me show exactly what Carmen was just making a point of. When you're back here, when you're looking at your valuation for the low price right here, average low PE of 16, and low earnings per share, you can actually, it should be auto updated. Okay, see, this is her SSG. So if you press that button, auto update, dear, it'll automatically do it for you in the future. So you don't have to manually do that. That's just exactly what Carmen was just talking about. So that brings your selected low
Thank
price
you.
30, just what you said. Okay, let's move on. Let's go to Microsoft. I can present Microsoft. I personally own the stock. So if anybody's been following Microsoft the last a year, everybody's saying how bad they are. They don't know anything about AI, et cetera, et cetera. Their stock dwindled from 500 down to 380. Well, their quarterly report came out last quarter. We look at the data right quick. And they had sales growth of 17% and earnings per share growth of 31%. And the stock went up $100 in the next week or two. It went up. It's up like 25% from our last meeting because the basic fundamentals were very good. And they did not raise their speculation how much money they're going to spend on AI. They're spending a ton of money on AI, but they said they're not going to spend any more than they've already said. So Microsoft took off like a rocket, and we happen to own it. So that's a good thing. And I'll make the point that we were buying Microsoft, but a lot of people were saying not to buy Microsoft. But we said, no, the fundamentals are good. So here's my SSG. Straight lines for sales and earnings, pre-tax profit. Well, to your estimate for sales, it's 19, earnings per share 15. I use lower numbers 13 and 14. Pre-tax profit on sales 50%. Oh my goodness. Return on equity 32%. Very little debt, although that may change with all their build out. Quarterly data, as I just said, quarterly data was outstanding. Sales up 17. Earnings per share up 31%. Valuation, current price is $495. It's been as high as $553, as low as, see this, it was $349 just a few months ago. And it's up to basically $500 now. It fits easily in the buy range. Upside, downside, 3.3 to 1. So everybody pat themselves on the back. We did well with Microsoft. We bought more. We didn't sell. Actually, I think we trimmed Alphabet to buy some Microsoft because Alphabet was expensive at the time. So that went well. Any comments or questions about Microsoft?
Randall, you might want to update your data because your TTM earnings per share is not the same as your low price earnings per share.
There you go. Let me go see. It says auto update. Why did it not have that? Oh, you're right, but I have it auto. I have it auto update. It didn't do that.
Yeah.
Was it 17.9?
No, but if you update the
30.
refresh data on the SSG, it should have changed.
I refreshed it this morning.
Oh, well.
You may have just refreshed the price. I think that's what
No,
she's
I
saying.
refreshed both data. I always refresh
Okay.
both. But anyway, Good point.
Well-
Good point. So with updated,
So your lower price should change now. Okay.
yeah, it's up to $429.
Yeah.
Yeah, and it's upside downside is now basically 9-1. So anyway,
Can
uh,
can I
yeah.
quickly share the value line for Microsoft?
Sure.
It's just a real quick here if we got this. Not now the only problem is this is the value line, but it's dated July 31st, so it's a little bit behind, but basically at that time it was 402. Like you said, it's already gone up $100. But all the timeliness, safety, technical, the projections are all good, 18% and 13%. It's got a yield of 1%, relative value. According to it's still good relative value, and let's see, what does it say? It just says that shares of Microsoft are down 4% in value since our previous pre-review, but that's obviously different. Now, management raised its full calendar year capital expenditure outlook to roughly 190 billion, well above Wall Street's expectations, and so on and so forth. And fiscal 2027 ought to reflect continued expansion. So they're positive of 2027, which is all good news. And these neutrally ranked shares have worthwhile appeal. So it's definitely a worthwhile stock to have in your portfolio. I'll stop sharing.
Excellent. So, Ione, do you have a Qualis ready?
I do. So, thank you to Pat for helping me with my quarterly stock update report. Qualys or QLYS is within the technology sector in the software infrastructure industry. We currently own 45 shares for a while now, and we purchased, I think, 2 different lots at an average cost of $133.62. The closing price on the 12th was $187.15. The most recent value line report dated July 10th, ending the second quarter, which ended in June. So the latest quarter percent growth sales perspective is 11%, earnings per share is 16, and then for value line, forecasted sales growth is 8% and forecasted earnings per share growth of 14.5%. So we pulled down the sales growth from 12 to 10, and we made forecast sales and forecast earnings per share growth rate of both 10%. So the current price of $187.15, the stock has a current PE of $32.04. The average PE is 42. I'm sorry. Current PE is 32.4 and the average PE is 42.8 for the past 5 years. So the current PE is below the average PE. Relative value is 75.6 with an upside downside ratio of 1-to-1. So even though the stock is on the border of the buy and the hold range, we recommend that we consider holding our position. Our SSG looks like this. And oh, I thought I had my value line. I guess
Look at
I
that
didn't.
52-week low. Did you show that 52-week low there of 74? Was that during
Yeah.
this apocalypse when everybody's saying don't buy software companies? That's unbelievable. It's double that now. It's more than doubled since then.
Yeah, and that's actually what we made our forecast low, 74.5. So even with a very low future low price estimate, the current price is still pretty low in comparison to what we think it could grow at. So
Well, all
any
those
questions?
software companies, we don't know about this apocalypse yet. Whether AI is going to eat up these software companies, and some of these companies just in the past month have just turned around, including Microsoft, Salesforce, et cetera. Okay.
So we have one more little bit of a snippet. While we are positive about Qualis's growth and margin expansion opportunities, it does still compete with some larger, better capitalized vendors like CrowdStrike and Palo Alto Networks, and also some private companies, Axonius and Flexera. Despite the competition, we are impressed by Qualis's ability to produce solid retention metrics, I guess, and keep their customer base happy. So overall, we believe Qualis's strategy of developing a variety of cybersecurity solutions is sound, as it enables the firm to upsell existing clients while strengthening its sales motion with newer customers. And that's my quarterly report. Update. Thank you.
Any other comments? Is Cindy here to give Visa?
Let's see. I
don't
don't
see-
actually, I think she mentioned, yeah, she wasn't going to be here.
Okay,
Did
well, I'll
she
bring it.
send it
I'll
in
bring
advance?
it.
Okay, thank you.
Let's see what I. So this is the SSG. Stock sales 2 years estimates 18 and 14. That's from Morningstar. We use 10 and 13. You can see this originally was from 22 when I first purchased the stock, I imagine. Pre-tax profits outstanding at 60%, return on equity is outstanding at 52%. Reasonable debt, a little bit higher. Better Investing recommends 30%. It's a little bit higher. Quarterly data. Sales the last quarter were up 14%, 17, 14, so it's pretty good. The earnings per share were up 10%, previous quarter 35, 17. So the 1 year has been up basically 15%. Currently price is 364, the 2-week high is 373. It was pretty low. It's down to 290 earlier this year. There was a lot of concern about MasterCard and Visa Card. Were they going to have to compete with crypto for people using crypto to purchase things? Listen to long podcasts. And basically, the point from the podcast is the retailers are not going to accept even stablecoin, but they will accept the MasterCard or the Visa card. And so experts think both these companies will do well in the future. This has been a great company for years. I think we should continue to hold it. It's done well for us. Any comments? Okay, Valencia, you're next with Netflix.
Okay, Netflix. Share. Okay, someone's gonna have to, because I don't have host disable participant screen sharing. Who's the hostess with the mostest?
Sorry. Let me see what I can do. All right, try it again.
Okay, just 1 second. Let me pull it up again. Got it.
Thanks.
Thanks.
Let's get in here 1 second. Let me get in here to my studies. That one. Anyway, just 1 second. Share. Okay, wait. How did that happen? Which
There you
screen?
go.
Okay. So I thought we'd do a new study together. How about that? Would that work?
Sure.
There we go. And I wanted to ask you something, Ione. I think before I always put mine at annual. Does that matter?
Say it again.
Does it matter when I put it at annual?
The estimate projections.
Yes.
Yeah,
The
it'll end
starting
up.
point.
Yeah, it matters. Yeah. So in general, the short answer is put it at annual because annual is that's just like basic level. Once you end up changing it to, let's say, like the last quarter, then the direction of your trend line will change based on the most recent data, that or quarter that's been published. It'll change it slightly, but depending on the highs and the lows of the quarterly data, it'll change it a lot.
Okay.
Yeah.
Okay, because what I typically do is just stay on annual. So then I don't
Yeah,
have.
that's just a safeguard method. Yeah.
Yeah. So, but anyway, so I wanted to do this because there are some other people who are joining that will look forward to joining that I really wanted to give them an opportunity to do an SSG, but also just let them know how easy and how we make these decisions as a group, but not individually, but just as a club. And as members, what we look at is looking for the equity, looking for the debt to capital. And I know that we said that it should
Are
be
you
about
sharing your
30.
screen, Valencia?
Oh, no, it's not. It's not sharing.
You mean the Word document?
You got a Word document up there, not the SSG.
Okay, hold up. Let's go. Let me try this again. Is it? Oh, it was 3, it was 2. Okay. There you go. Now we're on the same page.
Yeah.
Okay, good.
So
No worries.
yeah, because when I was making my comment, it was from memory. But to your point, just to answer the question, if you hit quarter, watch how the dotted lines move.
Yeah.
And then if you hit trend, right. So in your situation, it doesn't change too much, but in other situations, if there was like a very high spike or a very low dip in the quarterly data, if you had it on quarter, it would change your whole projections.
And I've noticed that. So what I've done, got into the habit of just doing annual so that I can get a chance.
So you could put it back so you don't forget.
No, So this is for today. We're doing Netflix together because there'll be people who will be doing this, who will actually 1 second, who will be doing studies. And I just really, this is what we were talking about for the PERT report. And I thought it was so critical because remember I was talking about how conservative we are in terms of when our projections. And I noticed when you did the report, Randall, you had it at, you had Microsoft at 12. I don't even do the 12 points. Or 12 point whatever. I just either choose if it's going to be 10 or 15. And I think mine was in a buy range, and I did 15 for my projected sales, and my earnings per share, I did 20. And it still came in the buy range. It did take my low price up a little higher, which was 449 opposed to 429. So those were things I just wanted to kind of put out there. So this is why I'm really conservative, and I only do this only because even looking at the analysts, what they project, sometimes I might do it just to see what it looks like and if it's even relevant or if it's going to actually work. But what I typically like to do for this is that I like to keep it as conservative as possible so that when I do update all my other my data, because previously it was in a buy zone for Netflix, which was back in January. But I wanted to do a more current one when I first introduced Netflix to the club. But this time I really wanted to be able to walk it through so that we as a club can we get an opportunity to see what the data, how we came to these conclusions, or because I know we have two magenta lines and I know we're just out of the quarter, but to see whether or not the fundamentals really, how they actually play out. And when we're looking at the PERT report, how important and significant it is to when we're making these decisions, when we first do the first SSG or update the SSG. So going to the valuation and return, it is, I'm choosing, well, first of all, let me say this part. I sometimes look to see if there's some outliers. Do I want to change anything? I could, but for me, I really don't want to. And only because this is relatively low, but they've been really consistent in terms of, I look at for how I try to look at it from a gap perspective of what the high was and the low, how were those points in between, or the distance in between, so that I can get a better idea of clearly 2022 appears to be really one of the outliers, but I wouldn't do either one of those, only because the gap is so huge between the lowest, and I could choose the highest, but they seem to be pretty much consistent. This would probably likely be the lowest in terms of the PE. So I won't change any of that. And the current PE is 24.6. So the highest has been, and this is where I get this is where I have my biggest challenge. Is once I choose the high PE, sometimes I'll do the 53, like it says. I might even do the 53.2, and sometimes I don't really think it even matters. And I'll average it out sometimes if it's higher or lower. And here is the low PE is 27.7. So I'll just do 27. As you
That's
see
fine.
you said, go ahead, you were saying?
I just said that's fine.
So this is where we are, because they're saying that the lowest it's going to be is 85. And this is where we had that conversation last month when I was talking about the low and how it's invalid for the upside down ratio. And we were like, well, I think I asked Randall this. It was, what do you do in this case when the upside down ratio it kept populate, or it's really relatively high? And it was that you can take the low price, and this is what the recent low price was 46.2, which is insane. When did it get down that far? I didn't see it.
That was 2 years ago, though.
2 years ago, 46.2. That's the recent. So this is the other part of putting this one here is the recent. I would prefer the 65.1, but it doesn't allow me to put the 65. Could I put it in here?
Yes.
You would have to type it in.
Okay. So we'll do 65.1.
Yeah. I would,
Now it gives me.
I would
Go
say
ahead.
I would say one thing. So the first option I think is a good habit. Choosing the average low PE, which you selected, but the current price is below that. If that happens, you instead of going to the next options below that you could actually just close the box, come to section 3, and
Oh.
look at what the low PEs have been for the last 5 or 10 years. And then you could pick your own. You could pick your own in the middle of the range. You could pick
Here.
one of the lowest and then
Mhm.
plug it in. And by doing that, so like let's say for example,
So if
the
we go
one
here,
that gave you the issue was the 27 point something.
yes,
Right, but close out the box.
there.
So yeah,
Mhm.
so in column E, you
Mhm.
see that the PE has gotten as low as 16.4.
Yes.
It's even gotten as low as 23.7. So you could pick 20, 21, 22, 23. You could pick one.
And so I'm glad we're having this conversation, because when I get to some of the and I'm like, I can't get it to work the way that I need it to work. And I was like, I don't want to use the average PE. So thank you for telling me that. So now when I pick this one, I can now go in here, is what the Ione is saying. And I could pick in between the average of the 16 and I could do 20, right?
Yeah, so in that top
Mhm.
one, yep, you do 20, you hit tab, and then you'll see it got as low as 63.7. If you feel like it's not
Mhm.
low enough, you can go in and change it to 18. You know, you
See,
can move it up to 22. So you also have that flexibility. You don't have to just go based on, oh, I picked the 5-year average low PE, it threw the thing off. I'm going to go to the recent low market price, or I'm going to go to average low price for the next one. You don't have to. You can. Those are options here.
Mhm.
And of course, as always, the last option is pick your low price number.
Oh.
But I think the whole point though of why I'm even telling you you can do this other way, which is actually how I do it. But it's so that you have your own reasoning. You have space within the
Mhm.
technology to have your own reasoning. So I don't generally pick the 5-year average low PE. I actually look at section 3 and look at the range.
Uh-huh.
And then I just pick a number within that range, the 5-year range or 10-year range. I pick a number that I feel this stock price 5 years from now can go as low as from a PE multiple perspective. And then I just move on.
Oh, see, and I'm glad we're having this conversation, because this is where I would before, when I would get these high uh upside down ratios. And I was like, why? And we talked about it before, it was again about doing the low price, but I didn't know that I could choose. I know we've done it before as an exercise, as a club, we've done it before. But that was so long ago. I thought we were more or less doing it to kind of see where you can kind of know how this actually works in terms of how it influences the buy and the range. But I said I really wanted to keep as close to what I project, because we know that the first page also drives this to know whether or not are we going to be consistent in terms of what we anticipate the growth is going to be. Is it going to be 10%, 15%? And if so, if we decide today we invest it, for every dollar that we invest, what we anticipate, can it achieve that? And we're looking at the behaviors of what the previous price earnings have been. So that's the reason why I wanted to make sure that we had that conversation, because
Valencia, let me make some comments here, if you
okay.
don't mind. The BI experts say use a reasonable PEs for the high and low PE.
Mm-hmm.
They don't necessarily use it. You look at the data, but you use a reasonable PE. So if you're looking at your high price, and they say rarely go above 30 for your high PE, and you've got what I would consider an unreasonable PE of 53. You're expecting 15% growth. You cannot expect a PE to stay as that high. And I think your high PE is way high. It should be 30 or 35, not 53. I think your 53 is
Okay.
unreasonable. The
Okay.
low PE, I completely agree with Ione. And also the other thing, if your price is giving you, your current price is so close to your low price, gives you unreasonable upside downside. You can
Mhm.
use 80% of the current price and that number they put in there for you to use.
Okay,
So I would certainly, I agree with Ione. I just kind of look at the PEs and I see what's reasonable, how low could go. And she showed you there were some low PEs in the last 5 years.
yes.
And that's a good way of doing it. But the high PE, I think you have to be reasonable. And I think an average high PE of 50, which has had happened, I don't think
Mhm.
we can project that out 5 years.
For the average to be 55, right? Or the 53,
No,
you're saying that
no,
it's high. So
yeah.
even looking at from where we have the lowest it's ever been in terms of the highest, it has been 41.6.
And it's going to be a bigger company
Mm-hmm.
and it's growing their earnings slower. I mean, I'm just saying better investing principles say, Janet, your highest P should be 30 or 35, and you're way above that. So
Way above it. So,
So
but
what
okay, go ahead.
okay. So before Randall made his comment, I was gonna make a comment, which I'll make now. And I only realized this in this discussion when I was showing you that I I don't know if anybody's ever said it before, but the front part of the SSG is based on what the company can control. Sales,
Mhm.
earnings per share, pre-tax
Okay.
profit, blah, 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 right?
Mhm.
But when you go to the second tab of valuation and return, right, where we just were, hit the second tab again. Okay.
Right, okay. Mhm.
When we start talking about PE ratio, what we're actually doing is talking about something that the company has no control. PE
Yeah.
ratios are where the stock meets the market.
Yeah.
So therefore, a high PE is reflective of how much is the market in a multiple perspective willing to pay for this company, and a low PE is how low or how cool or how, what's the lowest multiple that the market is willing to pay for this company. And the reason I'm stating it like that is because PE is generally out of the company's control.
Mhm.
So the reason I have a very detached methodology around selecting a PE is because it's really just based on looking at the market. So if you hit in section 3, Valencia, if you hit 10 years so
Yep.
that we can see 10 years worth of,
Yeah.
right? We see now to one of Randall's points, which is as this company gets bigger, then the market is willing to pay less and less of a multiple for the company. And we see that by the drop of the PE, right? In 2016, it got as high as 300. People were willing to pay 300 times earnings per share to buy one share of Netflix. But then it would drop 163, 157, 93, 94, 62, 61, 41, 47, 50. Okay. So to Randall's point, 5 years in the future, it may not go as high as what you're projecting. But I will also say that
Mhm.
the comment about capping a PE multiple of 30, right? That is very 90s. It's very pro internet. It's very it's the original way of how we valued or projected PEs, but it was actually way before the market started overpaying for companies,
Yeah.
especially in the tech sector. So, I mean, most tech stocks are way above a 30 PE multiple. So I'm only saying that to say, if you don't want to cap yourself at a high 30 PE, you don't have to, because the data shows that it could get as high as 40 or 50 in the next 5 years. But then again, to Randall's point, as Netflix gets bigger as a company and move, more into a large cap, mega cap company, nobody is going to be paying that PE for that. Usually those PEs are reserved for smaller startup, high talked about companies that people think have a lot of potential. It's outrageous, but still, the reason I'm just saying is PEs have nothing to do with the company performance. It has to do with the multiple that the market is willing to pay for the company. It's out of their control.
No, I would agree
So,
with what she said. I would agree with a lot what she said. I'm just saying I consider 53 a little bit high because you see it's coming down, but I agree exactly 99% of what Ione just said.
and so when I first started doing the SSGs, that's typically how I would do it based upon what the app would, or let me say the SSG would say, here's your options. But when you explain it to me like that, then it makes far more sense in terms of now because it's really truly based upon, if I say that these are the things that are going to happen, and I'm going based upon that in terms of what the company what we can control, then how much do I think that anybody will be willing to pay? Just like you gave me the example, or you shared with us about when the company grows. Is it really truly, are they willing to make that type of risk in terms of when they don't know if the returns will be the same? Because again, it's whether or not they balance. Again, you look at the things that have they been able to control the things in a healthier way for the company to generate and achieve to make it more attractive. So when we say that, then it is that now that you've told me this, I would say in the next 4, I could say now here's the other part. I would say 44.
Okay, fine. Let me insert this in, and this is not to change what you're going to say. This is to
Okay.
say my last piece and to make my point. The reason I think that this is a very important part of the SSG and that we need to be clear about what PE represents, not based on what Ione would pay, right? Because even though I may put 53 in here, that doesn't mean Ione is going to be paying 53. It is, to me, when I do my SSG, it is for me to get to a high price that the stock may actually hit. And why is that important?
Yeah.
Because when we do an SSG on a company and our estimates are too conservative, especially on the high side, when historically the high PE has been way past our high projections, our ceiling, I'll put as the 30 PE ceiling. What will end up happening is that when you look at your SSG, again, you bought the stock, you have the SSG, but because you did not allow for the market to tell you it is willing to pay a very high PE for this company, your SSG is going to tell you it's in the sell zone. It's time for you to sell. So go back to high price and put in a 30.
I put 34. What do you want to?
Yeah, put like 30.
30.
Yeah. I mean, well, yeah, the current PE is 25, but if it's sold like 5-year average PE is 53, what you'll see is that the high price goes low. So that means by the time the stock does shoot up and people are willing to pay 40 PE for this stock, your SSG is going to give you a signal of it's time to sell. And when it happens, I think that your SSG is giving you a premature sell sign. Because the market's willing to pay 50% for a stock you think it'll only be willing to pay 30. So that means you're going to sell at 30 or 35, not realizing the market's willing to pay 50, 60, 70, and it'll be just another stock that you sold short and you continue to watch rise. Because if you look at the last 10 PE, high PEs, it's sold at 300, 163, 157. I mean, who's paying 100 times earnings? clearly somebody for Netflix.
Yeah.
So that's the final point I wanted to make on that, the bow on that. How, yes, we may have our own conservative views on estimate numbers, but let's keep in mind that our conservative views help us to buy low. And I don't want our conservative views to help us to sell too early because the market is overpaying for stocks that we own, because we can't envision people paying more than 30 PE for a stock.
Yes.
Now,
Okay.
can I make a comment too? If you look at the current price, it's almost 80. Your goal is to double your money in 5 years. So it
Right.
should be about 160. Maybe 122 is too low if your goal is double
It
your
is.
money.
It is.
So maybe P30 is too low too. So maybe that's, what's your goal? Do you want to have double your money in 5 years? What PE is that?
That's a great
good
point.
question. That's the other part. That's where, so this is where it becomes where that moment when you decide what's the best PE if you're seeking to achieve what you say. What is the goal? And again, is that in 5 years, what do I want? Do I want five? How do I want to multiply this? And will it take me 5 years to double my money? Because this, clearly we just need to make sure that the indicators are there. So when it's time to sell, that we do sell after we've gotten in, made what we've made. So far, we purchased this, I think, $20 more than what the current price is, right? Or something like that. So I think $22 more. So we are down in this price. So if I use 34, which I think should be, that's still 38.
So
63
you might be still too low for
is
the
still too
double
low.
your money. I mean,
When I had it at 40, I think that was about the closest that I had it at 162.
yeah.
Yeah.
That's fine.
So I mean, that's a number that you should consider. What do you want? The same thing with the low price, as Randall made the point. The SSG gave you a 20% down of the the current price, because that's one of the ways that the BI people teach you how to calculate your low price, take the lower price. There is a 20% down and a 10% down. 10% down from the 52 weeks low and 20% from the current price. So those are numbers that you should keep in mind if the market goes down.
40 is fine, Valencia, because 40,
I think 40 is.
2 years ago, the high PE was 41
Now,
in
if
that
I
column.
if I remember correctly, Value Line's projections for future PEs, I don't remember the number, but it was coming down.
Yeah.
And we can see here on the data, PEs are coming down.
Yes.
But at the
It's
same
still high, but it's coming down. Yeah.
Yeah. So that's when you want to see, okay, I want to double my money. How PE is that? It's close to 40. Then the lower price, how much lower will go from our current price? And the SSG gave you information. They gave you the 20% down, and you can, and the 10% from the current price is very similar to that number, and very similar to the number you have here of 63.
Yes.
So I will consider this being relatively reasonable. Here, my average PE is 30. And between the 5 years average and the current PE, should be about 32. So it's not that bad.
It's not that bad. At this point, does it seem like it would seem like if I went any lower that it's over, that it's still at a higher price than we would want to enter.
Now the upside downside ratios is 5.8
to 1, 5.8 to 1.
Yeah. So it's not 3 to 1, but it's not 70. I think I saw a number like that before.
It's better than 3 to 1.
Yeah, definitely.
Yeah, it's fine. Again, Valencia, it don't have to be perfect, but I think between, Randall, me, and Carmen, you get a sense of how to come up with your numbers and what to keep in mind. It's not just you buying it,
Yeah.
it's what the market,
It's
you
what the
know.
market is. Yeah,
Yeah.
I wanted to do that because it was one thing when I'm doing it by myself and then I get it. It's still in the buy range, right? But at the same time, being in the buy range, I really would like to make better decisions in terms of what I'm looking for in terms of if does it have the characteristics and the fundamentals? Are they all intact for being able to make a sound decision of purchasing the stock, even for your personal portfolio or even for the club? And I believe when we first bought it here, when we first came in, all the things that were there, and I think we did those together because actually I think I shared, not think I did, I know I shared the information and not even understanding the trending downward of the PE. But we want it to be what, 30, right? That's what our ideal is. 25, 20, 30. That's what we'd like. So yeah. But
We
I
may
just
not, we may not want to buy above a 30,
Mhm.
but we should respect the fact that the market is willing to pay above a 30.
Yeah.
This is Bob at Fort Worth. One minor part is on the low price. If you just changed the ending number to 80% without changing your PE or your earnings per share, when you go down to the bottom of the page, your average return is going to be messed up in most cases.
In
So
here,
yeah. So you need to adjust your PE to match whatever your 80% or whatever you choose for your low price. If you just override that last box without changing anything else, it's going to be out of whack.
by selecting the 63.6.
Oh,
Yeah.
yeah. So you see in the first part of the box that 62.5 over to the right, over to the
Uh-huh.
right. Yeah, 62. So he's saying if you selected that and you would have just inserted down
Here.
below. Uh-huh.
Your bottom figure is going to be out of adjustment. So you need to go in what you all
Like
said
right
about
there.
Oh,
right.
take out the 3. Take out the 3. Just do 62.5 and
Okay, there we go. There we are.
and then scroll down and then say it now, Bob.
Let's see. Let's go down the bottom. Yeah, let me adjust my screen. So it's probably not going to be out of
I
whack
think
because you adjusted the PE to 20.
Yeah.
So, but if
yeah,
it was 30, yeah, go ahead.
no, I think you're right, Bob. So, but to your point, it doesn't apply to this, but Bob is giving us a cautionary tale for when people just out of the blue use that 80% without
Mhm.
putting an adequate PE in the low PE box. Even if they don't choose something, they still have to put something there. In an
Perfect.
earlier meeting, Bob, to your point, we had Joe Farrell in as a guest and he went through it. But yeah, it will mess up your in section 5, it'll mess up your
Am
You
yeah,
said it perfectly. Yes, thank you.
yeah. Thank you for
Well,
reminding us of
and I
that,
was going
Bob.
to say, I mean, basically, it's price to earnings. Now, the company has some control over earnings, they have no control over price. But obviously, if
Exactly.
the price is very high and the earnings are very low, that's a mismatch. And why is the price so high when the earnings are very low? So you're going to have a high PE, which is going to be off track. And so you're going to say,
Mm-hmm.
hey, something doesn't match here. As that goes lower, as that PE goes lower, your price is closer to your earnings and it's
Mm-hmm.
more realistic price of what the value of that company should be. So that's another way to look at it is price to earnings. And if it's out of whack, if the price is $1,000, but there are no earnings in the company, obviously your PE is going to be out of whack and real
1,000.
high, and it doesn't make sense.
Mhm.
So what's bringing that high price? It's the people, like Ione was saying, it's the buzz, it's the headlines, it's the future potential earnings of AI. But if it's 100 PE, that's 100 times earnings. Is it ever really going to match that? You're hoping that in 5 years it's going to match that, but we don't know that. But that's a long shot.
Okay,
Thank you,
we
Chris.
need to move on. I'm sorry. We need to move on.
You know,
It's
Randall,
almost-
should we just count that as our education section?
Well, no,
Yeah, I can give the education section. I was going to do Right Stock, but I can do that next month.
Well, I was gonna do. I don't know. I saw something. I don't know if you guys saw Mariama. I'm part of Group 4, and we're supposed to be presenting. And Mariama put together a cybersecurity presentation, but then she is in South Africa and she couldn't present. But she asked me to present for her. I didn't do the research, but I can present it.
Why don't we
Hello,
first
Christian.
just
This
just
is
a minute.
Yvonne. I'm a part of
Okay.
Christian's group. I don't believe one person should represent the whole group. We did not adequately do our research and agree on what we're going to present. So, Christian, I'd respectfully like to request that we present next month.
No problem. That's not a problem with me. I know that Mariama was put it together, and then she's in South Africa right now. She can't present, so I just stepped up. But I'm fine with holding off. I will respect that.
Why don't
Go
we?
ahead, Randall, if you want to go ahead
Yeah.
and present what you were going to present.
No, I can present that some other time. I think what we first have to do is Cindy is leaving the group, and we need $2,642 to give her. We have 800 some odd dollars. Do we not? Right now, I only plus what we get in the club, but we need to be able. We need to raise money. I mean, I think that needs to be done this meeting if we're going to pay her next month. Are we
I
not?
don't think, no, we don't have to rush to pay her. We just needed to make the vote. We actually have 3 months to pay her. So I don't
Okay.
think that we should rush that, especially
Okay.
since she just brought that up. And I do
Okay.
think that with our monthly contributions, we may be able to just pay her. So
So
That's
that would
fine.
mean we probably shouldn't buy anything for the next 3 months then.
mhm,
We
That's
should
right.
just let the money collect and gather
right,
up and see where
exactly.
we're at, and then see if we
Yeah.
have to sell anything at that point.
Or we may wish to purchase a different stock and which is better than what we have in the portfolio, and we could just sell something that's not as good. I mean, we do a stock comparison, sell the
Yeah.
best, and we do that. That's fine. Now, I have a short presentation on a new program currently under development by Better Investing. I don't know if you heard of it, the Right Stock program.
I
No,
I would,
not.
yes, but that's
But
only because
anyway,
I'm a board
I was on
member.
a conference call or podcast last week, and several of us raised problems with it. But I could do a 5-minute presentation on it if y'all wish, or
Yes,
I could do it some other
Yes.
time. Okay.
Yes,
Yeah.
I would love
Okay.
it.
But
'Cause I don't
before
know
we
anything
do
about it.
that, I just need to say, for the purpose of the recording and Christian's minutes, that the education section, Right Stock wasn't your education session, was it, Randall?
I was going to use it since I was told Group 5 did not have one, so I was going to
Was
use it.
not. Okay.
Yeah.
Because
Uh,
if we were short on time, I was just going to say that the choosing a reasonable PE, the extended session we did with Valencia could easily count as that. But anyway, go ahead, Randall. It's all yours.
So Right Stock is a new program developed by Better Investing for 2 reasons. Number one, they're going to try to get more people involved in Better Investing, new members. So they developed this program. And number two, also to help some stocks training. Now, what is Right Stock? Right Stock, and it's currently available on the Better Investing website, gives you 2 numbers. The first number on the left, the fit score, from 0 to 100 tells you if it's a high quality growth company. Basically, it's the front page, first page of the stock selection guide. Now, the opportunity score is also from 0 to 100 and tells one, is it priced at a good opportunity? That's basically what this is. Now, 2 scores, fit score for the quality, opportunity score for the price. Now, there are several of these things that I don't want to spend a long time in that, but that is the basic purpose of the stock. How to read your fit score. 0 to 100 measures the quality of the company. Your front page or stock selection guide. It is not a signal to buy. A score is not a signal to sell or avoid. This is just a beginning, like a screen, to look at the stock and to evaluate with your full evaluation with your stock selection guide. Once again, the opportunity score is 0 to 100. If the fit score is less than 60, you do not get an opportunity score, because basically less than 60, they're saying it's not a good growth stock, so you should not even look at the opportunity score. Then you use the 2 scores together. It's a strong fit score, strong opportunity score. It appears to be a strong quality company at a reasonable price, and you need to evaluate it. The strong fit, but a weak opportunity score, that means it's a high quality company, but you may need to put it on a watch list because it's not currently at a good price. And if it's just a weak fit score, you shouldn't be interested because it's not a high quality company. Common mistakes: using a high score as a buy, a low fit score as an avoid. Now, let me tell you what a few of us brought up to the management is we are concerned that new investors, enemy investors will use these scores as the final decision. And they'll say, oh, we got a fit score of 90. We've got a opportunity score of 90. I'm buying. And my other club, and I've looked through several stocks, and some of the scores don't make a lot of sense. So that is the concern of several senior members in Better Investing is, and I have to admit, Dr. Buss was a little bit big mouth this meeting, and he used the term, it's a weapon of mass destruction if you're not careful. So anyway, let me go quickly and just show you where you get it from your Better Investing. Okay, excuse me. So you go to the Better Investing website, the home screen. And here you have find great stocks. Click on that. Here we go. Right stock right there. And so let's put in one of our stocks right here. And, oh, we just talked about Netflix. Let's see what they have to say. So you put in Netflix. Bada bing, bada bing. Oh, this, at least in this score, it looks like it's an excellent fit and an excellent opportunity. Let's put
Olivia, you got a
in,
winner.
well, that's my point. But the key thing is you can't use this as the final decision. I've seen a lot of things that don't make any much sense at all. Let's look at Lilly. That's something that we've added recently. Says it's a moderate fit, but an excellent opportunity. Let's see. Let's do it Qualis. Why not? Excellent fit, not a good opportunity. Now, we as a club probably disagree with the opportunity. But anyway, I just want to introduce you. This is not completely worked out because they're going to make a screener, is what we've been told. But I just want to introduce club to this. But what Susie Artsberger, who's the head of the electronic part of Better Investing and technical support, strongly emphasized that these scores are just the beginning of your evaluation. And it will help you say, oh, at least it appears to be a quality company. And is it a good or not a good price? So I just want to introduce the club to this. This just is, they're working on it, but you can see this on our Better Investing website. And I just want to introduce this. Do we have any questions about this?
Thank you.
Oh, Randall, if you could scroll down below excellent fit, they changed the page here recently, the last 2 days, and it gives you it's pretty slick.
Yeah, they have sales quality, earnings per share, So, I mean, these are very interesting numbers. The valuation, they say PEG ratio is weak, the risk to reward is weak, projected return is weak. These are numbers, and I assume these are basically computer, because they come out, I think they change every day with the change of price. I think they're, computer created, and they're not evaluated every day by a Better Investing person up in Michigan. But I think they are helpful if one uses this to help you make your evaluation and to decide. I mean, for example, let's say you read the annual report, core report, realizing they're coming out with new products and you expect those to do well. Well, you may think the opportunity is more than the score will give you because you think it's going to do better. But it's a good starting point, I think, for people. And also, there's a website that you can go get this. Let me see if I can get that website up.
While Randall pulls that
Yeah.
up, let me just say, nobody in college goes to the dollar store or Dollar Tree and picks up a grade 1 math workbook for themselves. So with that being said, Right Stock is actually more for non-BI members than it
Yes.
is for BI members,
They're trying to bring in members. Yeah.
Yeah, and simplify what our offerings are in a way that is in language for people that are not used to studying stocks, don't know who or what Better Investing is, and definitely don't know how to navigate the SSG. So for a lot of us who, was taking calculus as a beginner investor, when somebody dumped the whole SSG on us, and I know me, I was dumping SSG plus on people. I wasn't even letting them start at SSG core. This hopefully is an opportunity for people to have a warm and welcoming entryway into Better Investing that have no idea. And then hopefully the stickiness of it will get them encouraged to do a deeper dive into the SSG itself. So yeah.
Yeah, I mean that's what it's for. I just wanted to give you an introduction because as we look at stocks and look at our old stocks or new stocks, I think it's a good thing to look at. But it's mostly, as I said at the beginning, they're trying to get new members into Better Investing, and you could get like 3 of these a month free if you're not a Better Investor, and so and that's why they brought it out. So just to mention that.
Thank you.
It's an awesome tool. I like it.
I think you have to be careful. What I was concerned, Einstein made a statement like decades ago, pretty smart guy. He goes, you can make a problem as simple as you can, but not more simple. And I'm concerned they're making this too simple. And people are just going to use these numbers. They're not going to do the SSGs. They're not going to evaluate the companies. And the results will probably not be as good as you would normally have if you know what you're purchasing. So that's my personal concern. So do any guests wish to come off and speak for a moment? Want to come say hello?
Lola, Joyce, Howard, Christopher, Brian.
I can say I thought that was great, the practical application going through when Valencia was doing the SSG, because sometimes we're picking numbers and we know everyone has advised us on how to pick the numbers, but the real why behind it and how to think towards the future is helpful as well and should be considered. So that for me was excellent. Thank you, Valencia.
You're on
Thank
mute,
you.
Valencia.
This is Bob.
But thank you,
The
Dennis.
points you made on looking at the average PEs for the low and the high and inserting those in, I learned from that. That's a good point. This is a good meeting.
Thank you, Bob.
Thank you, Bob.
Thank you. Yeah, I also.
Oh, Zelda's on. Great.
Oh, oh, sure. I can turn my camera on. Hello.
Hey there.
Hi. Yeah, it was helpful to look at those ratios. I haven't looked at really, analyzing those and really doing the deeper dive. And then thanks for showing that fit. Is it the fit test?
Right.
The right fit test, yeah. So thanks for going through the SSG, and it's always helpful to see how to analyze and just make better estimates. So definitely improve it. I love coming here, so I'm glad you all are Model Club. We can come and listen and learn, and don't necessarily have to join. So thanks a lot.
Thank you.
Thank you.
This is Marion Walsh. I also just wanted to say thank you for letting us sit in. I'm a Better Investing member, but not part of a club, and it's always good to see how other members analyze stocks. So thank you for letting us sit in.
Thank you, Marion. Pleasure to have you.
Well,
Hi, this is Howard. I just wanted to say hello. I'm brand new to Better Investing. I just recently joined. This is my first meeting, and I thought it was unbelievable. I've learned so much just from this meeting, and I look forward to future meetings and learning and hopefully more actively participating. So thank you guys. You did a great job.
Thank you, Howard. Welcome to Better Investing as well.
anyone
Christopher?
else?
Good morning.
George?
This is Chris Serrano. I'm fairly new to Better Investment. Just retired, so I'm kind of thinking about, hey, let me kind of spend some time in this and start learning. And I appreciate you allowing me to kind of spend some time with you guys and get an idea of and the hang of how this works. But fairly new. Probably started with Better Investing maybe 3 weeks, 4 weeks ago. But I've been an active member of AAII for probably 15 years. Most of my experience is around traditional indexes. This is the first time I've been kind of jumping into individual stock selections. Gives me something to do, but like Christian mentioned during the present, or at least when he was talking, is in the back of my mind, I think is it worth it or not to do it, or do I just stick with the regular indexes, right? But on the other hand, at least I've done I've done 3 reviews, and I've learned a lot out of the companies, which is something that is very interesting to me. So that's what I get out of it. And I'm not looking to beat the market. I'm just looking to learn and, keep up with the market and hopefully keep my fingers crossed a little bit better than the regular market. Thank you.
Thank you, Christopher. Welcome. You may, since you are a BI member and kind of getting into this and you've been in AAII for a long time, there's a section on our Better Investing website called First Cuts. You can type in a company you've been looking at and you can read some SSGs and reviews that other Better Investing members have done on a certain stock. So that may interest you.
I did do the videos, the learning videos and the judgment videos. I found them very helpful. I like the Better Investing methodology. But in the end, all of this is, you're just trying to kind of reduce your risk factor. And
yeah.
But I do like the methodology, how they approach to the investment and how do I analyze a company.
Good. Well, thank you. We're happy to have you.
Thank you very much. Happy to be here.
Thank you. Margot. Yes. And Brian. Hi, Brian. It's been a long time. I think that's it, Randall.
I think Margot had put said on the comment earlier, and going back to the ResMed, she had said something that was really interesting. I think we discussed this in previous meetings that there's a revenue concern with ResMed that the popular weight loss drugs could cause a reduction in ResMed use because sleep apnea is associated with weight loss. And so that's something that a lot of these drugs are taking over. So that's another thing to consider a headwind for ResMed.
Yeah, 2 years ago, ResMed stock crashed when the GLP-1 drugs first came out. Then they realized not everybody's going to lose. I've seen all sorts of patients as a physician who have sleep apnea. Most of them are obese, but many are not. And so that thought was supposed to affect patients, the need for it, but that's been around for a couple of years. So anyway, our next meeting is September 19th. We'll be voting, and Group 4 will present education. Do we have somebody willing to present a stock, a new stock?
Can I really quickly share something real quick before we
Sure.
Go
right ahead.
I just want to we've talked about this. So can everyone see my screen? The
Yes.
stock watcher assignments. So basically, as we can see, I updated my Microsoft, and we have some stocks that need to be updated and or linked. So that way next time, and hopefully by next meeting, we can get these updated. I know that Cindy's leaving, so I don't know if someone's going to have to take that over, but that's just a housekeeping item for next time if we can try to tackle that.
Okay.
So will anybody pick up Visa or present a new stock? That's 2 things to ask for.
Group 4 in our discussions, we are thinking of presenting a stock called Fortinet, but we should have that ready for next month in conjunction with our presentation.
Perfect.
Okay.
And I'll be doing ResMed.
Perfect. It's an interesting stock, Carmen. I'm sure you'll be all over it. So anyway, I hope everybody had a great day. I think we all learned. No matter if you've been in this for 2 weeks or 35 years, you learn at every one of these meetings. I'd be in the old part of the room. So anyway, everybody have a wonderful weekend. We'll see you in a month.
Good day.
Thank you.
You
Bye.
too. Thank
Bye.
you. Bye-bye. Have a nice
Good month.
weekend.
Thank you.
Bye.
Happy Labor Day.